Hello, welcome to our webinar on how does relief funding affect your taxes. Magda is our Spanish interpreter, and I'm going to have her share now how the interpretation channel will work.
Thank you, Leanne. Good morning, everyone. We're going to be offering interpretation in Spanish. If you want to connect to any of these channels, wait until the host activates the channels. And once that is done, if you're connecting from your computer, look at the menu below. You will see a globe icon that says interpretation. Hit that button and choose the language of your preference. If you are connecting from a cell phone, go to the top right corner of your screen and you will see 3 dots. Keep those dots and you will see the option language interpretation. Tap that and choose the language of your preference. We remind you that if you are an English speaker, choose English as your language. Otherwise, you won't be able to listen to the interpreter when they are interpreting for non-English speakers. So now I'll go ahead and say the instructions in Spanish. Bienvenidos. En esta oportunidad estaremos dando interpretación en español. Si es que se está uniendo de una computadora, vaya al icono de globo que aparece abajo, selecciónelo y así podrá elegir el idioma de su preferencia. Si es que está en un teléfono celular, en la esquina superior derecha de su pantalla van a ver 3 puntitos que al apretarlos aparecerá la opción de interpretar idiomas y elija el idioma de su preferencia. Thank you so much. I'll pass it back to you.
Thank you, Magda. My colleague Margaret will now activate that interpretation channel.
As Magda instructed, if you would like to join that channel, select the globe icon on the bottom toolbar, and you should be able to select the Spanish channel if you wish to listen in that language. Leanne, we are ready to go.
Excellent. Okay, we'll get started. So as I mentioned, today's webinar is on the topic, how does relief funding affect your taxes? The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Now I'm going to give an overview of today's conversation. We're going to discuss how to recognize key relief programs and their general tax implications. We will also talk about how to identify the general impacts of relief programs on tax filings and how you can use this information as a resource when you file your taxes. This sort of relates on the disclaimer I just read, but the information is not intended to serve as, it's not intended as a substitute for personalized advice from a tax preparer. Instead, it's really intended to serve as one of many resources in your toolkit. Okay, so both the state of Georgia and the United States federal government have dedicated many resources to support childcare programs throughout the COVID-19 pandemic and in the years following. While these relief funds were highly needed and well used, many childcare business owners have wondered how this funding will affect their taxes. Different relief funding programs will have varying impact on your federal and state taxes because funding sources are governed by different tax laws. The key to take away here, though, is that it will have an impact on your taxes, and that's what's very important to remember. Most state relief programs, including stable funding, which many in the state of Georgia received, they provide funding to cover costs that you already have paid or will need to pay soon. Consequently, you must report the funds that you receive as income on your federal taxes in the year that you receive that payment. This means that the federal government will tax your grant money at your federal income tax rate. Because you will need to pay taxes on relief funds, your tax bill will most likely increase. However, you can offset that increase in your tax bill by claiming the expenses paid for with grant funds as a business deduction. So a lot of people hear that it will impact their taxes and think, why would I want to do that? but there are upsides of relief funding. So let's look into the upsides of relief funding in the tax process. First, federal taxes on relief funds do not affect how greatly you are taxed on your earned income. The additional tax money you are paying is being taken out of the funds you received from the grant. Second, expenses covered by the grant continue to qualify as a deduction. Let's look at an example case. So we're going to talk about a provider named Ashley. Ashley was eligible for the STABLE program, and she received a total of $5,400 in support in 2023. Ashley allocates this money to her rent and her utilities. When Ashley does her 2023 taxes, she can still report rent and utilities as expenses. They both qualify as eligible business deductions. So this means that Ashley is reducing her tax burden by deducting eligible expenses, even though those expenses were paid for from relief funds rather than Ashley's earned income. Ashley's 2023 earned income is $40,000. As a single filer in 2023, Ashley would owe the federal government $8,581.10 in taxes on that money if she did not receive a grant. However, Ashley needs to add the additional relief grant she received to her income. Ashley adds the $5,400 in relief funds to her taxable income. Now, Ashley's taxable income has gone up. It's $45,400. Ashley is in the 22% federal tax bracket, so she is now taxed an additional $380.82 on the $5,400 relief grant. This increases her federal tax bill from $8,581.10 to $8,961.92. Although her federal tax bill did increase by that $380.82 that we mentioned, Ashley was able to put $5,019.18 of STABLE program funds toward her expenses. Ultimately, she ended up with more money than she would have otherwise had, and she was able to reduce her tax burden using relief-funded deductions. The receipt of the STABLE funds allowed Ashley to help her business and her family. So the key point here is that although she owed more taxes, she ended up with more money than she would have anyway. We're not suggesting that the relief funds are not worth it. We just want you to be prepared for the additional taxes that you will have to pay on this money. Sometimes people are surprised that government funds, grant funding from the government is taxable. Most of the time, the vast majority of the time, it is taxable money, and that's what we want you to be aware of. Another form of federal relief funding that we want to talk about is the Families First Coronavirus Response Act, also known as the FFCRA, and the Employee Retention Tax Credit, also known as the ERTC. You may have received either of these credits to help reimburse you for payroll expenses that you maintained while your business operations were impacted by the pandemic. Both the ERTC and FFCRA are refundable tax credits meant to offset wages that your business paid out. Funds received from the credits are taxable and will be included in your gross income for federal or state tax purposes. We suggest that you consult with your tax professional regarding these credits. We also would like you to know that we will be offering individual coaching on both ERTC and FFCRA through the Thriving Childcare Business Academy beginning in the new year in 2024. Stay tuned for more information about those coaching sessions and how you can access them in the new year. In-kind supplies. This is another form of support that many childcare providers get. If you received in-kind gifts of tangible supplies rather than money to buy those supplies, you most likely will not face a tax liability. We suggest you consult with your accountant or your tax preparer to determine the best way to record the donation. So even though it is not a tax liability, you still want to keep records of all donations that you receive, including in-kind supplies. Now we're going to talk about tax treatment for state funding sources. So Any COVID-related funds and other money in the form of funding, stipends, etc., anything that owners of center and family home-based programs receive from DECAL for their child care projects will most likely be considered taxable income by both the state and federal governments. So it's not just when you're filing your federal taxes, it's also applicable when you're filing your state taxes. Within this general rule, there are some distinctions for family providers. For example, if the owner of a family childcare learning home employs a teacher and receives financial support earmarked just for teachers, those funds are income to the teacher, but not to the owner. However, if the family homeowner is the facility's only teacher and she receives those same financial supports, it is taxable income to her. That would be the case if you were the only employee at your family home. The other wrinkle is that while the vast majority of the family home providers are licensed as individuals, and any individual benefits to that facility would be counted as taxable income to the owner, some family homes are registered as single member LLCs. In those cases, the funds would be treated as income to the LLC, not personal income to the owner. To determine the proper and legal way to treat the federal relief funds you receive for income tax purposes, please consult your tax advisor. As you can see, this can be complicated, and we always recommend reaching out to your support professionals for help. You should receive 1099 forms from DECAL, ClassWallet, and similar funding sources for all the monetary payouts you or your childcare business receive during the tax year. These 1099s will help you and your tax advisor identify the benefits you need to include in your tax filings and how to treat them. For CAPS providers, the 1099s will include the total of both CAPS and stable payments. You will also receive an invoice from Maximus with details to help you understand which part of that total amount is for CAPS and which part is for stable. Here's a little more detail on tax treatment of state funding sources. So any COVID-related funds, this looks like a lot of the same information that we just had, but this is just a little chart that sort of lays out that information about the COVID relief funds and how they are taxable. The key here is that while the payments are taxable income, please remember that all of the expenses are deductible. In general, what you can spend these grant funds on are business-related expenses, and all of those business-related expenses should be deductible to your business. If you received pandemic relief funds, it likely has been and will continue to be critical to your childcare's business financial operations and recovery from the pandemic. While this support can increase your tax liability, the new income that it offers to you is valuable. The best way to prepare for taxation is to organize your expense documentation, your receipts, your payroll expenses, anything that you spend money on, and differentiate the sources of income used to pay for your potential deductions for federal versus state purposes. This is because what you are allowed to deduct may vary between your federal and your state filings. You should then set aside an amount of funds equal to your marginal tax rate so that you are prepared to pay any owed taxes. If you are unsure how much you will owe in taxes, you can always use 22% of your income, what you have left when you subtract your revenue and your expenses. 22% is the most common tax rate in the United States, so that is a fair estimate. For more business tax resources, I would suggest visiting www.civstrat.com/taxes. At Civitas Strategies, we are a partner with DECAL for the Thriving Childcare Business Academy, and we have a host of tax resources on our website, which is civstrat.com/taxes. If you want to get a detailed picture of what you owe, you can do a tax check-in. The best time to do this is before the end of the year. So you still have a couple weeks left at this point. The reason that we suggest doing it before the end of the year is because that allows you to see where your tax liability is while you still have a chance to affect your tax liability. Because at the end of the year, a lot of those chances that you have to affect your liability will end because you have to spend the money in that tax year in order for it to be eligible on that tax return. So additionally, conducting a review can help you to understand your tax liability because you are required by law to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes. If you do not do so, you will be penalized. And the penalty is money. It's a fee that they will add on. So a tax review before the end of the year can help you plan how much more you need to pay in estimated taxes to avoid paying even more in penalties. This review would involve looking at your revenue, all of the money that you took in over the course of the year, and your expenses. We recommend comparing expenses from this year against last year, as well as the resulting profit, which is revenue less expenses, to see if it's gone up. If it's gone up, you'll know that you likely, if your resulting profit is higher, chances are you will owe more taxes. So you want to take a look at that and think about ways to reduce that tax burden before the end of the year. You'll also want to check how much you have paid in taxes so far. That is how much you would have paid in estimated tax payments, those 4 quarterly payments that you make throughout the year. There's a QR code on the screen, and if you have questions about your tax burden at all, I'm going to highly suggest that you scan that code, and links to an app we've developed that allows you to see your tax burden, and it helps you learn what you can do about it. It's called the Proactive Tax Planning app. Proactive tax planning is really your compass to navigate the complex world of taxes effectively. It's like looking at a map before you're starting on a journey. It really helps you chart a course that can save you time, money, and headaches along the way. I cannot emphasize this enough. It's really helpful to know where you stand with your taxes before you begin preparing your tax filing. It's not a time that you want to be surprised with anything. You can do this anytime throughout the year. We call it sometimes a mid-year checkup, but you could do it middle of the year, any time of the year. It's always helpful to stay on top of that. But we think of it as a checkup because just like visiting a doctor for a health checkup ensures that you catch and address issues early, a mid-year tax check-in can help you spot potential tax challenges before they become problems. By reviewing your finances now, you can make informed decisions to optimize your tax situation. Unfortunately, taxes are a part of life, and paying them is a legal obligation. To stay in the good books with tax authorities, you will need to meet specific tax payment requirements. Ignoring these obligations can result in penalties and unnecessary stress. When you go to look at this Proactive Tax Planning app, you should plan to have information on your revenue, expenses, and estimated tax payments from the year to date. The more specific information that you bring to this process, the more accurate your results will be. Knowing how much you owe in taxes is only part of the exercise. As I mentioned, the app can help you mitigate your tax burden. And when we say mitigate, we really just mean reduce. So you want to identify how you can reduce your tax bill while you still have time. This on the screen, you'll see a list of some of the most common strategies used by tax providers. The first one is contribute to a retirement plan. If you don't already have a retirement plan for your business, setting one up could provide tax advantages. Often that federal funding, the relief funding we mentioned, can be used to fund retirement plans for your business. You need to check on the details before you do so. But if it is allowable under the relief funding that you received, it's a really great way to use it. Contributions made to a retirement plan on behalf of the business owner employees are typically tax deductible. You also want to think about maximizing your home business deduction if you're a family care provider. If you are a family care provider, one of the greatest deductions you can get is for the business use of your home. So you want to make sure that you are recording your time accurately and capturing expenses by either exclusive or regular use and calculating your time space percentage correctly. These are all key ways that you will save a lot of money on your taxes. If you're a center, you may also have a home business deduction. If it is appropriate, if you have a home office that you use, you should look at ways to deduct those appropriate home office costs. We also suggest that you look for other deductions. It really can be worth the effort to review the things you need for this year and next. Are there items that you can stock up on now? Maybe there's a play structure that you've wanted to replace for years, or anything that you are renting or leasing that you may want to buy. It's important to note that you don't want to spend frivolously. Spending money on something just to reduce your tax burden if you don't need it isn't helping you. But if it is something that you need and you can make the purchase this year, that will save you money on your taxes. That's great. Pay down debt. So this isn't technically going to help you reduce your tax burden, but if you have extra money, paying down your debts is a great way to save money for your business in the long run. We all know that interest rates are higher than they have been in many years. And so if you have debt, you know that you are paying more in interest now than you have in the recent past. Another way to potentially reduce your tax burden is to invest in business expansion. If you have higher profits, you might consider investing in the growth of your business. This could involve hiring more staff, expanding your physical premises, launching new products or services, or investing in marketing and advertising. These are all eligible business deductions, and they could potentially lead to even higher revenue in the future. Another way to mitigate your tax burden is to defer income. If it's possible, you might consider deferring some income that is owed to you this year to next year. This could involve, for instance, delaying the billing until the beginning of next year if people owe you money, parents, anyone else who owes you money. However, this strategy should be used carefully because it does increase your tax burden for next year. Because even if you're receiving that income, just because you're not receiving it this year doesn't mean it goes away. It just means it'll be applied to next year's taxes. And then charitable contributions. Finally, consider making contributions to charitable organizations. Not only does this support the community and it can act as advertising for your business, but it could also provide your business with a tax deduction. If you have any questions, you can send them to gacoaching@civstrat.com, and we will try to get back to you. Thank you again for taking the time to view this webinar. Before we close, I just want to take a moment to go over all of what we talked about today. So hopefully after today, you will be able to identify state funding opportunities and understand their tax implications. And really, if you take one key item away from this session, it would be this, that most of the relief funding you will receive now or in the future will be taxable income. So we hope that you will also be able to take advantage of any federal or state COVID relief programs and properly report them on your taxes, and be prepared for tax season with accurate records of your income sources and your spending. We hope this information is valuable to your business, and we look forward to seeing each of you again on another Thriving Childcare Business Academy webinar in the future. Thank you so much for attending. For more information, visit the Decal Thriving Childcare Business Academy website at decal.ga.gov/thriving. There you will find our entire library of self-study guides. They cover a range of business topics, including taxes, relief funding, a lot of what we talked about today. On that website, you can also see the schedule for upcoming webinars, and there will be a link to register for those. And you can register for our small study groups. Our small study groups are groups that are capped at 5 participants each, and they are a great opportunity for you to take a deeper dive into topics that are relevant to running a childcare business now. The small size of these groups allows you to get more personalized help on the issues that are affecting your childcare business. If you participate in these groups and complete them, you also can be eligible for 4 state-approved training hours and a $300 stipend. Thank you so much for your time today. We appreciate it.